Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending April 25th, 2025. Thank you all for tuning in and liking and subscribing to this video. And I'm titling today's video, Is the Rebound Real or an Opportunity to Exit? We will dig into that story here in a bit. But before that, I want to get to all the economic data, give you the heat map, and all of this surrounding the markets this week. Now, this is the performance of the S&P individual names for the week. And you see a lot of green. Really, only you saw the communication services names, AT&T, Verizon, T-Mobile. Those were down. Some consumer staple names like Procter and Gamble and Pepsi not doing well. United Health, but the rest of the names out here pretty green. In the Mag 7, up between 5, 7, 8%, and pretty solid rebound. Now, year to date, you can see here there's still a lot of red. Nice rebounds, but still a lot of names kind of down in that 10% range, 10 to 20% range, and with some green, right? So a lot of these banks are doing fairly well, a lot of consumer staples doing fairly well, a lot of solid returns out there still. Okay, so I wanted to highlight that and give you kind of sense from week to week as well as the full year where we are at. Now, on the economic front, I try to ignore a lot of the March data because the March data, it's pre-liberation day, and that's not what this economy is about. It's about what is happening now, how are companies feeling, how are consumers feeling, and we'll look at this in a minute. But here's the Richmond Fed -13. This is April. Okay, so a sharp deceleration into deep negative territory and back to where we were kind of end of last year. And so that was poor. You had the Kansas City Fed Manufacturing Index that did also tick down into negative territory. So those were poor. On the jobs front, kind of hanging in there. You had unemployment claims tick up a little bit, but they ticked down last week. So you're kind of still in this range where we've been really since early or call it late March, or beginning of March, excuse me. And I'm not seeing anything that's telling me that in this data series that the labor market is deteriorating rapidly. I am hearing anecdotally there are layoffs, and this is certainly causing a lot of trepidation within the business community. So maybe this comes a little later, but so far, okay. On the consumer sentiment front, 52.2, this is the lowest level, geez, going all the way back to June of 2022. This was at 50. Now, I love this. This is coming from Apollo Management, and this is a great slideshow here. And these are anecdotal evidence. I went Southwest, Chipotle, Pepsi, all pretty negative when it comes to how they're feeling about the overall economy. And they give this breakdown of what they think, how they think it's going to play out. So April 2nd was Liberation Day. Early May, so call it in a week to 2 weeks, container ships into U.S. ports stop, right? Because a lot of those ships have stopped being sent here. They take 3, 4, 5 weeks to get here, but those will stop. And then you have mid to late May trucking demand halting, right? Moving less goods, and then layoffs in trucking, retail, and end up in a recession in the summer. That's pretty on point with what we're thinking as well. And we are in the midst of earnings season, and this is the sharpest decline in earnings outlook since COVID. Okay, so this is firms with a higher, less lower 12-month EPS revisions as a share of total revisions. So what's the ratio here? Okay, and you're seeing this tank. New orders collapsing. Okay, this is all different. Philadelphia, Dallas, Richmond, Kansas City. Philadelphia is the worst, obviously, but overall ISM new orders down as well. So that's ticking down into negative territory. And then corporate capex spending, that's rolling over as well. These are all the different surveys that are out there, and those are rolling over as well. Prices paid, those are ticking up. So you're having the stagflationary environment. Inventories uh, up. Now, obviously, those will be drawn down if they're not importing as much. But what you're seeing is inventories kind of piling up here. Now, how are they responding, right? New orders falling, inventory, all of this. This is kind of the breakdown of how Apollo looks at this. And we pretty much agree with all of this. Now, the Fed, they are likely to pause. They have their meeting not tomorrow, but the day, not tomorrow, not next week, but the week after. And they are likely to pause. And the market thinks that they will likely start easing in June. I think they're going to wait a little bit longer. I think they need a little bit more data on how this impacts inflation. And you're not seeing it show up in the labor market yet, right? So they probably need a little bit more clarity on labor. You will get a labor data point at the end of next week. Friday is the first Friday of May, and that will give us a data point there. So the market will likely move. That market will probably move a lot next week based on this incoming data. There's a lot of April data that finally kind of comes in, and we'll get some harder numbers as opposed to a lot of the softer survey data. Okay. Now, by the end of the year, the market does expect about 100 basis points in Fed rate cuts, but kind of leaning, what you can see here, is on a little bit less. So maybe 2 or 3 versus the full 4. Okay. Now, one thing that's positive here is banks are lending. Now, is this companies coming out there and borrowing money to try to uh, get them through this period, to make sure that they have enough liquidity over the next 6 months or a year? That could be part of it. And the big question is, will banks pull this back at some point? But near term, this is certainly a positive for liquidity. Banks are lending, and those companies are actually taking that credit, and that puts more dollars into the system, and that is net positive. Now, the debt ceiling is coming up here. I wanted to pull this up. So this is the debt limit should be reached between mid-July and early October. That's kind of a wide range, right? Call it August, September is kind of the range that'll likely be hit. This is from the Bipartisan Policy Center. And so this directly correlates with here, which is the Treasury General account. What's interesting here is this is rising the last few weeks, and it shows that the Treasury is going out there and borrowing money. And this was being drawn down. People were paying their taxes, and so there's less need for borrowing. Okay, and so they probably didn't want to borrow, waiting for maybe tariffs to push rates down. I think that's what their plan was: draw this down and then borrow. And they've been borrowing, but not at lower rates because they had hoped. And so this is actually countering that positive impulse out of the bank credit. Remember, this is the Treasury General account. This is the bank account of the Fed, of the Treasury. And so when they go and spend money, meaning this goes down, that's money into the system, into the economy, and is a net positive for liquidity. When this goes up, the opposite happens. So is this part of the reasons why the market's got a bit more rocky? Obviously, the headlines as well. But something I'll be watching, because if you pull this back to a 5-year chart, which you can see is in 2021, this dropped dramatically, and this pushed dollars into the system. And one of the reasons why you've got such a great market in 20 and 2021. And then in 2022, you see this rising, and you had a rough 2022, right? So I wanted to highlight that, and then they drew it down, significantly in 2023. That improved markets, and the rest is kind of history there. So this is part of the story, and I'll be watching to see if this rolls over again or this moves higher. Right? If it moves higher, money's being pulled out of the system. That would likely mean a rockier time. Now, also, they could draw this all the way down to zero, and then once they do reach a debt agreement, then this could start rising again, and that could be an inflection point lower once again. So, something I'll be watching, and can be very important to the overall liquidity with out there in the system. Now, let's get to some of the charts here. Okay. So first off, I want to get to, here's the S&P. I'll start off with the S&P. This is pretty easy, right? We had that breakdown here, and we're back into this breakdown area. Now the big showdown here will be around 56.50, and this range is the 618 from high to low, as well as where you had pretty much where the market was pre-liberation day, and you had that breakdown. Okay, that is going to be big resistance. If we get above that, we hold above, especially the 50 moving average. We have that as well. You have multiple data points here. This is massive resistance here, right around 56.50. Would not shock me to see us get there next week, and then that's where we'll get a lot more information. Do we get a massive reversal or not? So that's when he says, is this real or not? We'll find out. Do we chop in this range between say 55 and 56.50 for a little while and build some energy to break through to the upside? That would be the positive outlook. I don't think it's going to slice right through this and get all the way to 5,800 and 5,900 in short order. That's just there's too much, right? The major resistance is that 5,800 area. This is the real breakdown area from back in February. So, there's a lot of overhead resistance here on the S&P in general. And my question here is on tariffs. It's kind of like you kind of have the Trump tariff call option, where it's like, okay, if markets are positive, there's more impulse for Trump to keep these tariffs off and and stay strong with the tariffs, which would be a catalyst for weaker economy and the market rolling over. So I find it hard to believe that this is going to stick for especially the first time. There needs to be get through this 90-day pause. Does he extend it again? Are there any trade deals? Are they significant trade deals? Do we still have the issues with China? Are they still, even if he says they're going to come down, right? That was part of the reasons for this rally. Oh, they're going to come down. Well, they're 125%. It's basically an embargo. If you bring those down, is that 50? Is that 30? Is it 10? Where is that? And 10's manageable. Maybe 20 is manageable. 50 is probably not manageable, right? So it all depends on what he means by they'll come down considerably. Okay. So that's something that the market will continue to react to, as well as, like I said, incoming data from the various economic reports. Here is the NASDAQ. This is the same thing. Here's the uptrend line. This is another aspect that we'll be watching as well. Right, this is the 618, right, in this area, breakdown level. You're actually almost there from the Liberation Day. So this one's getting into resistance rather quickly. The 50-day as well, right there, and 618, it's all the way up here. So what you can see is this is generally weaker. It's not even above the 50% retrace like the S&P. And you can see that this is definitely some negative rotation and some more overhead resistance. So I feel like next week is more of a pause at best, and could potentially be a rollover if some of that economic data is a lot worse than expected. Here's the NYSE, so broader index. This one looks a bit better as well. Let's take a look here. Run this Fib. And this one also, that 618 overhead resistance rather quickly. Remember, this is more mid, small caps as well as those large caps, 2,500 names in NYSE, and looking to test this area, this breakdown area. So once again, a lot of overhead resistance in markets as we head into next week. Now let's take a look at gold. Gold is doing well. Had a bit of a pullback this week. It needed that. It was definitely overbought. You zoom out to a weekly chart, and this is far away from the moving averages. When this happens, let's clean this up. Look at this reverse head and shoulders I drew back here, and this was the target on gold. Obviously, it hit that and then some. But what you see here is, there we go. What you see here is something that's overbought, high volume reversal last week. It's on the cover of Barron's this weekend. This is signs that gold is tired. It needs a consolidation period, a pullback period. This is not a good entry for gold. I'll just say that. Okay. GDX also with that reversal. Now, does that mean that gold has to reverse and head all the way back? No. I think there's too many tailwinds generally for it. But does GDX pull back into, let's say, this 44 range, right? We're at 48 now. Does it have a 10% pullback? That would not shock me, right? Retest this breakout area. Would not shock me to get something like that on the GDX. Gold. Do we get a pullback into the 50-day? Probably needs that. Maybe it's pulls back all the way to the 100-day, right down here around where it was in early April. That would not shock me as well. So understand that gold probably not the best entry point, and I'll still be buying on pullbacks, but it is something that looks a bit toppy and tired in the short term. Okay. Let's go look at the credit markets. This is also something I will be watching. So this is a breakdown, right? The credit markets broke down. You had a lower low here. You're getting a bounce. 50-day moving average overhead here. A lot of overhead resistance in the market in general. So just a heads up there. I wanted to highlight all this. This is very important to watch because we're getting a crucial time in markets, and we'll know a lot more as we head into the summer. Once we get this overhead resistance tested, do we get consolidation or do we get a quick rejection? And I think we'll probably soon find out. This is the dollar. Dollar getting a bounce. This is in a downtrend. Still no real traction there. I still think there's weakness in the dollar ahead, even though maybe you get a stronger bounce. We'll see. But here's the euro. Euro looks fine. The yen looks strong, and this is also a impetus for a potential rollover once again in markets. If the yen continues to get traction, it breaks out higher. Right. This is the yen carry trade unwind. We had a pullback, made a higher low, and now we're looking to create that uptrend in the end, and that would could precipitate more yen carry trade unwind. So we'll be watching for that. What else do I want to get to? I think that about does. I should look at bonds, TLT. So this is interesting. Is we had the Liberation Day. Yields originally dropped, right? Bonds rallied. This is the TLT, and then it reversed, and it hasn't really gotten any traction, right? You had a little bit of move higher over the last week, but overall, bonds are looking bearish. That's all you can say when you have a move down and a consolidation. This is what we call a bear flag for a move lower. You can see Williams R. This is now overbought in the short term. And once again, if that starts to head lower, bond prices sell off, that could, you're starting to see bonds and equities become more correlated, and that would be negative for the markets as a whole. Well, I think that about does it. I kind of covered most of everything. Actually, lastly, let's go to the move index. Move index. This has been positive, right? You pull back here into support. Does the move index move higher? Right? This is where there was some unruliness in the treasury market. You started to get the move index 140. I say 150. That's where things get really bad. But we've come back from the brink at least. But there's still an uptrend, and we'll be watching to see if this gets any more traction to the upside, or does this continue lower, a lot like the VIX. And the VIX has come down. So this looks similar to what we got in August, but remember, this went all the way down into the mid-teens. We're going to need to get that. We're going to need to get the VIX into the mid-teens for everything to kind of be hunky-dory in markets once again. If this stays elevated, low to mid 20s or higher, that is bad for markets. So some progress here. Definitely 50s are crazy, but this is still in an uptrend. This is still at elevated levels, and if it stays in an uptrend, that's once again bad for markets. So we'll be watching to see that next week. So in a lot of ways, next week is a make or break week for markets, economic data, and then the week after we get Fed meeting. So a lot still to be decided outside of the tariffs. And you start to get a little bit more clarity, a lot more clarity, I think, over the coming couple of weeks. And so buckle up. That's what we were in for the next couple weeks in markets. Well, I thank you all for tuning in and liking and subscribing to this channel. And a reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.